Hello everybody, Luke Gromen, FFTT. Hope you had a great weekend. I certainly did. I'm going to jump right in here with this week's edition. From Mike, Luke, what do you think would be some of the likeliest outcomes if, per se, Japan and or European nations were to abandon energy sanctions and quote-unquote side with Russia out of energy necessity? I think you need to think through it in terms of, at least how I'm thinking through it, is the short answer is I don't know, but when I think about it, I think through it in terms of flows. And so you're probably going to end up with, for example, if Japan starts buying Russian gas in yen, Russia ends up with a lot more yen on their balance sheet. You probably end up with a lot more Russian and Japanese trade as Russia spends that yen back into the Japanese economy. And then you probably need a neutral settlement asset that starts to absorb some of those yen energy commodity flows, which I would think would be gold. So it'd probably be good for gold demand, all else equal, as gold gains further share as a neutral reserve asset. Geopolitically, I'm sort of spitballing here, but I think you'd probably see calls to pull the U.S. military out of Japan, force Japan to spend more for their own military defense. I think you would definitely see such calls if the EU were to do something similar. And so with that in mind, from the geopolitical side, maybe the most obvious economic outcome would be forcing the Fed to start buying EU bonds or Japanese government bonds simply as a way of preventing that outcome of them sort of moving to the Russian fold out of energy necessity. And to me, the Fed doing QE on European bonds or Japanese government bonds would probably be negative for the dollar at a time when sentiment's pretty positive on the dollar, but that's all still hypothetical, speculative, and on the come. So from Nina, if Russia exports to Europe keep being shut off, how does Europe recover economically? They have very little oil, some coal. While Russia is losing a lot, they can find other buyers for their gas, but for Europe, it's very hard due to gas infrastructure not being there. In my opinion, it's going to be very difficult for them to recover economically. I think Europe is facing a extremely severe economic crisis. We've been writing for months that Europe is puzzlingly running what we've called the post-World War I Weimar Germany playbook, which is you lose some chunk of your energy inputs and then you try to print money over top of it to prevent the inevitable economic calamity that occurs when you start removing energy from an economy, and you end up with very severe stagflation. And so additionally, as EU goods get potentially removed from global supply chains due to unavailability of energy, you end up with worsening global supply chains, further breakdown of those supply chains in the US, in China, in Japan. And that puts more upward pressure on inflation, more downward pressure on bond markets, more upward pressure on global bond yields. And the West is the most levered. Russia has very low leverage at the sovereign level, the West very high leverage. And that creates more systemic financial global system pressure on the West. Now, when you look at it from a trade and competition standpoint, China's probably not that upset about Russia putting pressure on the EU or Japan in this way. Everybody's focused on the impacts of well, not everybody, but some people focused on the impacts of a weaker euro or the weaker yen in competing against China. But China's still buying Russian energy. These other two aren't. To some degree. And so while the weaker euro and yen, all else equal, make it easier for those regions to compete with China, if they don't have energy, they can't make anything. They can't make enough stuff. China is taking that energy. So energy availability is really the first principle there. That's the master resource. So the other thing I would say within all of this is, and I think it's critical, in 4Q97, early in my career, Southeast Asian economic crisis nearly collapsed the global financial system just 9 months later through the long-term capital management link. Given much higher debt levels, given how much bigger the EU is than Southeast Asia was then, an EU economic crisis will likely be more than enough to collapse the global financial system much more quickly than 9 months. So that's something I think to keep an eye on. And in that case, as we move in that direction until the Fed pivots, I think dollar and maybe gold are the only winners. From PM, you've said before that the system is breaking, so why then has the Fed not pivoted? It seems like Powell is more serious than he's ever been and intent on breaking inflation's back, even if it means a hard landing recession. I had, from this time last year through probably earlier this year, really thought the Fed was bluffing. I, 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 I thought they understood that the only thing keeping the global system from a severe crisis was the inflation. The Fed needs the inflation to keep U.S. debt sustainable. Apparently, the Fed is choosing to ignore that mathematical reality. So, why are they not pivoting yet? I think it's partly that they're being dogmatic. I think it's more that they have been politicized domestically to fight inflation by the Biden administration. And I think they've been politicized internationally to fight Putin, to try to sort of break him with the dollar and break China with the dollar. Regardless of their motivations, a soft landing will be, I think, enough to break the system. I think a hard landing will be enough to break it even faster. And the reason that is you'll see deficits rise as we go into a recession, even into a slowdown, let alone a recession. That sends Treasury issuance up. At the same time, the Fed's selling Treasury. At the same time, foreigners are selling Treasuries because of the strong dollar. And sort of unclear demand, and that gets you into sort of this death spiral vortex we have shown numerous times in FFTT, which is dollar up, yields up, everything else down, wash, rinse, repeat until either the system crashes or the Fed blinks and has to start regrowing their balance sheet very aggressively. From Scott, is there any level of U.S. dollar as measured by DXY carnage that forces a weak dollar policy pivot? Or is the Treasury hemmed in by oil and CPI? Or is the Fed hemmed in by oil and CPI? Is there a cap on this move, i.e. do yen and euro devaluations and the Bank of Japan losing the yield curve control fights ever spook policymakers, or are there much bigger domestic concerns? I think the credit market problems creating enough dysfunction in markets, and in particular the Treasury market, that they have to react is the catalyst. It's the trigger, regardless of where CPI and oil are, in my view, and especially if there's Treasury market problems. You've started to see some sort of what I would call pretty weak Treasury auctions 2 weeks ago, for example, into what we're seeing with the economy. They shouldn't be that weak with the economy weakening the way it is, but I think that in and of itself is a signpost. From John. Double-digit inflation for 5+ years can probably reduce debt to GDP to below 80%, is something you've said in the past. Is this real inflation or CPI? Yeah, in April 2021, we wrote that U.S. would need to grow nominal GDP somewhere between 15 to 20% per year for 5 years, mostly driven by CPI inflation in all likelihood, in order to get debt to GDP below 80%, which is the level we estimated that the Fed could then normalize policy without blowing up the system. Fast forward, they began tightening beforehand. We've had the worst start to the year in a long, long time, depending on what you're looking at. This is the worst year for the 60-40 equity bond portfolio on record, going back at least 50 years. So the view that, hey, if they try to tighten too fast, they're going to blow things up, it's playing out. So we saw it start to work last year. You went from 129% to 122% debt to GDP, 7 percentage points of improvement in 2021. All it took was 11% nominal GDP with 8% CPI. They needed to keep it going. They're making a policy mistake by not doing it. That's what we're seeing play out in markets. If they keep this up, it's going to be the beatings will continue until morale improves. Dollar up, everything else down, till either the system collapses or the Fed blinks. From Frank, if the base case of tightening breaks markets, the economy hurts tax revenues, leading to a Fed pivot, leading to inflationary boom bust. If that doesn't play out, where or how is that path most likely to break down? Politically, it breaks down, possibly, or we actually get some sort of systemic collapse and policymakers stand aside and just let that happen. I think you also could see some version of, I hate even talking about this stuff, world war, famine, these types of things. You could see that type of breakdown stop with this. It's important, I think, to understand with sovereign debt levels this high in the West, we're not dealing with a dial here. We are dealing with very binary outcomes. They're either doing enough or they're not. There's no middle ground. And we're seeing that. We've seen that in the asset performances year to date. They keep it up, it's just going to keep getting worse until either we get a nonlinear decline or they're forced to pivot. If you ask me by base case, I think they may be forced to I think they may be surprised to find a whoosh down and then a policy response of truly face-peeling amounts of money printing. From Bob, do you have any changes in the way you feel about gold? Have your thoughts changed about the timing or manner in which this cycle ends? No, nothing has changed with how I've thought about how I think about gold. I don't like that it's down. I don't lose any sleep that it's down. Strong dollar and rising rates in the U.S. are going to bring forward the day that either the Fed blinks or the system comes unhinged. And either way, I think gold is going to be in pretty good shape if/when that happens. I also still think gold will keep gaining share as a global reserve asset, particularly in the commodity and energy trade over the next 5 years, which I think will also be good for gold. So I continue to like it. And like I said, my thoughts on it haven't changed in any way. From Brad, would love to hear your analysis on when the rise in rates will start to really put a crimp on the federal budget. My understanding is while rates were low, most of the bonds issued were short duration, so they'll turn over relatively soon. I don't have the numbers in front of me. I know they've been terming out debt. In other words, weighted average coupon of U.S. Treasury issuance has been up pretty notably over the last 12 months, to their credit. I think in my opinion, the best way to look at it is a simplified way of looking at it, something I've been tracking for over half a decade now. But in 2016, the U.S.'s big three expenditures, which are entitlement pay-goes, Treasury spending, defense, they were about 65% of tax receipts. After just 18 months of interest rate hikes, they were over 100% of tax receipts in 2018. After COVID, they hit 140% of tax receipts. They're now back down to 110%, but they're likely rising again with the decline in tax receipts that is now beginning. So in plain English, they're already a problem. Rates are already putting a crimp on the federal budget. True interest expense got back below 100% of tax receipts last year, thanks to that nominal GDP growth of 11% and 8% CPI growth. But now again, with tax receipts rolling over, they're now likely back above 100% of tax receipts and will soon be. So basically, you're in a situation where either the Fed prints entitlement pay-goes and Treasury spending, right? They print the interest, or rates rise to attract the capital. The dollar rises, and in the midst of a recession, and then you get into basically a high risk of a global death spiral until either the system collapses or the Fed blinks. And again, you get into a recession with Treasury yields rising, it's not going to be a good situation for the U.S., not be a good situation for anything. And I think we're seeing the early signs of this already as we speak. And then finally, brings me to the last question from Browning. What happens if the Fed does not pivot in August? As we've said, we think the Fed pivots by the end of August, given what we're seeing in credit markets already. I think if they don't pivot by the end of August, you're going to see the dollar rise non-linearly even faster. I think you'll see everything else down non-linearly. I think you'll probably see long-dated treasuries bid for a cup of coffee and then start to go down with everything else. I think you'll be looking at a serious risk of a market dislocation across a number of markets: stocks, bonds, emerging markets, commodities, housing, sort of everything. So we're really getting down to crunch time for the Fed to pivot. And discouragingly, I saw today Raphael Bostic, Atlanta Fed president, talking about employment. Employment's a lagging indicator. He was talking about employment in May of last year, that employment needed to get a bit better before we start tightening, and we're not worried about inflation. He was late on that, and now they're talking about unemployment or employment markets still being good, so we're not too worried about a recession. He's late on that too. Things are slowing meaningfully. So with that, finish up for tonight. I appreciate everybody joining me. As always, if you like these updates, check out FFTT-LLC.com. Check out more information about what we're up to, as well as our tree rings product. Quite popular. 10 most interesting things. Quick synopsis of what grabbed our attention about each of those things and whether they are confirming or refuting a way that we were thinking about the world when we read those things. So, as always, thank you very much for joining me. Look forward to chatting with you soon. Take care, everybody.